Look around the room you are sitting in right now. The screen you are staring at, the clothes you are wearing, the materials that built your walls. Roughly 90% of everything you consume was brought to you on the back of a ship. So let's say you have $150 million in liquid capital, and you've decided you want to own the actual physical arteries of the global economy. You want to buy a massive container ship. It costs more than a commercial airliner. It costs more than the GDP of some small island nations. But here's the strangest paradox of global trade. The name painted on the side of that massive steel hull usually doesn't own the ship. When you see a giant vessel with Maersk or MSC painted on it, you assume you are looking at a maritime empire. You are not. You are looking at a mirage. In the highest tiers of global shipping, ownership is completely divorced from operation. So who actually holds the deed to these $150 million floating cities? How do they make their money without ever moving a single piece of cargo? And why is this specific asset considered the ultimate, hyper-leveraged call option on global chaos? Welcome to the dark economics of owning a cargo ship. Before you wire the funds, you need to understand exactly what you are buying. You are not just buying a boat. A modern, ultra-large container vessel is essentially a self-sustaining industrial city. You are paying for over 40,000 tons of specialized steel, mathematically welded into a hull designed to flex in a massive ocean storm without snapping in half. Inside that hull sits a two-stroke marine engine taller than a four-story building, capable of producing 100,000 horsepower. It is built in a massive shipyard, usually by the China State Shipbuilding Corporation or South Korea's Hyundai Heavy Industries, with an expected operational lifespan of exactly 25 years. But here is where the institutional trap begins. The price of this asset makes absolutely no sense. A cargo ship doesn't behave like commercial real estate. It behaves like a highly volatile, unhinged tech stock. The price you pay depends entirely on the spot price of raw iron, shipyard capacity, and the ultimate wildcard, global shipping demand. During the economic crash of 2008, the valuation of some vessels dropped by more than 40% in a single year. Ships that cost $100 million to build were suddenly worth $60 million before they even touched the water, simply because the world stopped buying flat-screen TVs. You are buying an asset whose intrinsic value fluctuates wildly with the macroeconomic cycles of the planet. So if operators like Maersk or CMA CGM prefer to remain asset-light and rent these vessels, who are you competing against? Who actually buys them? You are entering a shadow ecosystem. The real owners are Greek shipping families operating out of secretive family offices in Athens, who currently control roughly 20% of the world's entire merchant fleet. They are German tax funds, Japanese leasing conglomerates looking for massive depreciation write-offs, and ruthless private equity firms operating out of sleek high-rises in London. These owners do not care about logistics. They don't care about getting a PlayStation from Shenzhen to Los Angeles. They are in the leasing business. But owning an industrial leviathan carries catastrophic risk. If your ship leaks millions of gallons of crude oil onto a coastline, the environmental fines will bankrupt you instantly. So the elite use a corporate legal shield, the Special Purpose Vehicle, or SPV. If a Greek magnate owns 50 ships, he does not own them under one holding company. He creates 50 separate, anonymous shell companies. One company, one ship. They are strategically registered under flags of convenience in jurisdictions like Liberia, the Marshall Islands, or Panama. Why? Because if one ship goes down, spills oil, or defaults on its debt, the authorities can only sue that single shell company. The rest of the 49 ships in the fleet are legally untouchable. It is the ultimate firewall for billionaire capital. Structuring that level of offshore corporate shielding requires institutional-grade precision. In any high-stakes market, the difference between the apex predator and the prey is how they track their capital. Now, if you want to manage your own assets with that exact same cold, calculated logic, you need to use the Sur Capital Portfolio Tracker. It's the internal Notion system we use to monitor liquidity, alternative assets, and market monopolies. The link to download it is in the description. Now, back to the high seas. Now that your corporate structure is bulletproof, how do you actually extract cash from this floating piece of steel? There are 3 ways to lease your ship. The first is a time charter. You rent the vessel to an operator for a fixed daily rate. say $40,000 a day for 3 years. You cover the crew and insurance, the operator pays for the fuel. It is safe, boring, predictable income. The second is a bareboat charter. You hand over the keys and the operator handles absolutely everything. It's lower income but zero involvement. But then there is option number 3, the spot market. The spot market is where generational wealth is forged and where empires are broken. In this market, ships are rented voyage by voyage. The rates are not fixed, they are entirely at the mercy of global panic. In this market, your cargo ship essentially becomes a financial call option on geopolitical chaos. When a global pandemic breaks out, you profit. When Houthi rebels attack vessels in the Red Sea, forcing ships to take the long route around Africa, supply drops, and you profit. When the Ever Given famously got stuck in the Suez Canal in 2021, halting 12% of global trade in a single day, spot rates went absolutely parabolic. Ships that were normally renting for $15,000 a day were suddenly commanding $150,000 a day. Ship owners became billionaires in a matter of months simply because the world broke down. But the hangover from this casino is brutal. When supply chains normalize, those rates can plummet by 70% overnight. And that is when the bank comes knocking. You see, almost no one in this industry pays cash for a $150 million ship. It is an industry built on extreme, suffocating leverage. The standard financial architecture is 30% equity and 70% bank debt. Massive maritime banks provide colossal loans secured by the physical vessel itself as collateral. This works perfectly when global trade is booming, but what happens when the spot market crashes? Let's do the math. You borrow $70 million to buy a $100 million ship. A year later, a global recession hits. The resale value of your ship plummets to $50 million. You are now underwater on your loan. The collateral is officially worth less than the debt. When this happens, maritime banks don't wait. They execute a margin call. They demand cash injections immediately. If you don't have the liquidity to cover the difference, the bank seizes the ship. Shipping history is littered with the corpses of over-leveraged companies that thought the boom would last forever. In 2016, Unhinged Shipping, one of the largest operators in the world, collapsed under billions in debt, leaving 85 of their ships stranded at sea like ghost ships, unable to even pay the port fees to dock. Leverage in this business is a loaded gun. It makes you a king during a crisis and bankrupts you during times of peace. Let's assume you navigate the debt perfectly. You still face a final, unavoidable enemy, the green swan of environmental regulation. A physical ship lasts 25 years, but the global push to decarbonize is turning the industry upside down. Regulators are forcing sudden mandates for new fuel systems and massive exhaust scrubbers that cost millions per ship. Furthermore, you are forced to gamble on the future. What happens if you build a $150 million ship today that runs on liquefied natural gas, only to find out in 10 years that the new global standard is green methanol? Your magnificent ship instantly becomes a stranded asset. It becomes too expensive to retrofit, illegal to dock in certain high-tier ports, and impossible to sell. Its $150 million valuation evaporates. But this is where the cold, metallic logic of the shipping industry reveals its ultimate safety net. Even in death, your ship has value. When a vessel reaches the end of its 25-year life or becomes completely obsolete, it is sailed one last time to the shipbreaking beaches in places like Alang, India, or Chittagong, Bangladesh. There, the captain runs the massive hole aground at high tide. The ship is then ripped apart and dismantled by hand. The owner doesn't sell the ship, they sell the raw, physical weight of the steel. Even completely destroyed, a large cargo ship will yield roughly $15 million in scrap metal. It is the final, absolute financial floor to the asset's value. This is why the global shipping system functions the way it does. Operators like Maersk keep their balance sheets lean by renting the vessels, while the ghost owners in Athens and London absorb the brutal financial hits. Owning a $150 million ship isn't just about renting steel. It means structuring offshore immunity, managing staggering amounts of debt, predicting macroeconomic cycles, and constantly betting on geopolitical chaos. When you multiply that risk across hundreds of vessels, you begin to understand how modern maritime empires are truly built, not through the physical control of the cargo, but through the relentless, cold-blooded calculation of risk. If you found this institutional breakdown valuable, subscribe to Sir Capital, and remember to click the link in the description to access our internal portfolio tracker. Until next time.